Hi again. Let's get started with part 3 of this chapter, where we'll look at the indirect method of reconciling net income to cash flows provided by operating activities. Cash flows provided or used by operating activities are reported in one of two ways, the direct method or the indirect method. These two different methods apply only to the operating activities section. The direct method separately lists each major item of operating cash receipts, such as cash received from customers, and each major item of operating cash payments, such as cash paid for inventory. The cash payments are subtracted from the cash receipts to determine the net cash provided or used by operating activities. The FASB, Financial Accounting Standards Board, recommends the direct methods because investors understand it better, but it is very time-consuming to prepare, so most companies don't use it. The indirect method differs only in the way operating activities are reported. It does not report individual items of cash proceeds and payments. Instead, it reports a number of adjustments to reconcile net income to net cash provided by or used by operating activities. The FASB permits this method, although there has been talk about only allowing the direct method. That thought worries all of us accountants, believe me, because the direct method is not required and the indirect method is so much easier for accountants to prepare. Nearly all companies report operating cash flows using the indirect method. And finally, note that the cash amount provided by operating activities is identical under both the direct and indirect methods. This equality always exists. The difference in these methods is with the computation and presentation of this amount. We will be using the indirect method to prepare the operating activities section because it is cheap and easy compared to the direct method. The indirect method starts with the accrual-based net income and makes three types of adjustments to arrive at cash flows from operating activities. A few adjustments must be made to accrual-based net income to get to cash flows from operating activities. The first adjustment includes changes in non-cash assets and current liabilities. We'll discuss these on the next slide. The second type of adjustment involves adding back non-cash items such as depreciation and amortization on the statement of cash flows. This basically cancels out the fact that they were originally subtracted to arrive at net income. Since these incomes do not represent cash outlays, we wouldn't want to include them in the statement of cash flows. And finally, we also need to adjust for gains and losses that result from the sale of an asset. Gains are added on the income statement and losses are subtracted on the income statement to arrive at net income. Since the gains and losses do not represent operating cash flows, we cancel out gains by subtracting them and cancel out losses by adding them to net income in the operating section. The actual cash flow from the sale of the asset will be properly reported, in most cases, in the investing section. This chart explains how to treat a non-cash current asset or current liability in the operating section of the statement of cash flows. I suggest you memorize the steps because they are a bit complicated. It is easier if you start with current liabilities. Notice that if current liabilities increase, we add them back to net income. If current liabilities decrease, we subtract them from net income. You can think about liabilities this way. Current liabilities decrease when they're paid. Therefore, the decrease in current liabilities should be subtracted from net income to get to cash flows from operating activities. Once you have that down, notice that changes in current assets have exactly the opposite impact. If you're interested in more information, your textbook has a more elaborate explanation about this topic. Now let's try a small example using East Incorporated. Write down these amounts so you have them available. East Incorporated reports $125,000 in net income for the period. During the period, accounts receivable increased $7,500 and accounts payable increased $10,000. During the period, East reported $12,500 in depreciation expense. Our challenge is to determine East Incorporated's cash flows from operating activities for the period. First, start with net income of $125,000. Then, add back non-cash items such as depreciation expense. You would also adjust for gains and losses in this section, but East did not report any, so we just add back $12,500 in depreciation. Next, use the table we looked at previously and determine whether to add or subtract the change in non-cash current assets and current liabilities. Since accounts receivable current asset increased, the change needs to be subtracted from net income in the amount of $7,500. Since accounts payable, a current liability, increased, the change needs to be added to net income in the amount of $10,000. Now, as we can see, East Corporation's cash provided from operating activities is $140,000. Notice that if we use the direct method, we would use a different format, but we'd get the same answer. Cash flow from operations is the most important predictor of a company's ability to meet its obligations, pay its dividends, and expand its operations. The ratio shown here, cash flow on total assets, is a similar ratio to return on assets, except it reflects actual cash flows rather than accrual-based income measurement. The cash flow on total assets ratio is used with income-based ratios to help assess a company's performance. It is calculated as cash flow from operations divided by average total assets.